Sorry if it's not. 1 second, let me test. testing. And we're just going to wait until we absolutely know that the audio is working. And it's just here. Sorry if it's not. There we go, audio. Cool. All right, guys. Hello and welcome to the stream. I'm going to be talking about 𝗏𝗏𝗏𝗏 Discovery. They just released their earnings yesterday, and I've had the chance to look at the one and only thing that I really care about, which is their debt. So the thing that I'm going to be caring about next quarter, which is typically their most profitable quarter, is revenue and cash equivalents, is Q4. But in Q3, we just want to see, sorry, where we are with debt payments. All right, got my cup of tea. Suggest you get yours. I'm going to do a shorter version of this on my main channel, 𝗟𝗂𝘀𝘁cie𝗵𝗿, but for this channel, this is just to make sure that I get some content out there, because I've done a bunch of research on this today, posted it on Reddit, which is maybe where you come from. And so, yeah, why don't I get sharing my screen, make sure there's actually something to share. So there should be a Chrome tab here. Not that one. There's the badger. And so, yeah, we are here on 𝗏𝗏𝗏𝗏 Discovery's investor relations page. So what we need to talk about is the debt. 𝗏𝗏𝗏𝗏 Discovery have had an interesting quarter. The share price is down 20%. As of speaking right on this video. They had a bit of a jump, 10% earlier this week, so really down from where they were at the beginning of like a week ago. It's not a hell of a lot of difference. I think some people for a short period of time expected their earnings to be beyond expectations, and actually they were under expectations. Of course, the earnings that have just come out are from 45 days ago. This is the marker that we're seeing is from 45 days ago. And so the environment has potentially changed a lot since that point of time. I think it's always important remembering, we always forget that when the earnings come out, that's 45 days from the actual point that the earnings were recorded. So that is why CEOs and stuff like that, people extrapolate a lot of recent behavior to the earnings. However, of course, that information is already very, very old. Okay, this is September. That's September. So the CEO knew about all of this for 45 days. And so what has happened is we've got revenues and stuff going down due to the things like the Screen Actors Guild and the strike on AI. And then we've got, the funny thing is that free cash flow is up. So free cash flow is at like 2 billion. So I'm going to explain why this is in this stream, and I'm also going to talk you through the 2.4 billion of debt they paid off and how that looks when it's modeled. So let me get my debt sheet up here. So in Q2 2023, their debt looked like this blue line. And then in Q3 2023, the debt looks like this red line. And so what that means is basically they got a lot less debt to pay off in 2024 and still about the same in 2025 and a little bit more in 2027, but not much more. Then across the entirety of all these years, you can just sort of see that the blue line, the peak in 2029 has now been brought down a bit. So they paid off some debt there. Potentially that was because it was high interest debt. I could look into that, but it's not particularly important because these numbers as well are interest factored in. So, and then this is the entirety of their debt, stretched from all their debt to their last payment in 2050. And so you can imagine with inflation, these things are going to be absolutely no issue at all. The big risk is here, 2025 Q1. I expect them not to have paid that off, but more likely they will stretch that payment into the future quarters and trying not to hit this quarter here, trying to make it as easy as possible to afford these payments. So this is the sheet that I've made. And let me walk you through it a little bit because I will include a link to it in this video, but I include a link to it on Reddit. Basically, this is the original data. I just copied and actually, let me go right back to the beginning. If you go to 𝗏𝗏𝗏𝗏 Discovery's investor relations site, you can go to their quarterly results page. And what you can do is you can actually download their debt schedule. And so what I did was I went and downloaded this. And if you copy and paste it from here, it's not going to work. So what you've got to do is download the PDF, open the PDF, copy it, and then open it in Google Sheets. And then I pasted it, and it was a bit annoying, but it pasted it like this. So all in a jangly sort of mess. And so then what I did was I created a bunch of substitutes. And what they did was they removed all the spaces from the names and stuff like that and standardized it a bit so that when I did the next bit of code, which was a split and just split it by spaces, without me having to do a thing, I've got it all in lovely, neat little columns here. So I've got beautiful, neat little columns. Let me just check that you can see that. Oh my God, I'm talking without the screen on. Okay. Right, I'll just walk you through that again very quickly. You go to the 𝗏𝗏𝗏𝗏 Discovery, Investor Relations, Quarterly Results. You go to, you can download the debt schedule. And what I did was I went to 2023, downloaded Q2 and Q3. And like I said, you don't want to copy and paste them from here. You want to open a PDF and then copy the data from the PDF because it won't paste very nicely. When you do that, it will paste like this. And if you split it just like that, what you'll end up doing is you won't have everything in neat little columns. So what I did was I created this, I used substitutes, and I just made all the names and stuff like that. And anywhere there was an odd space, I made it so it replaced it and did it without the space. So that when I did a split formula, and I used an array so that I didn't have to write split in every single column. But yeah, I did a split formula and that split it like this. And so, yeah, there you go. Everything split into a nice, neat little column that fits almost on one page. And so I got Q2 2023, and I did not type out any of this. That's the beauty of it. Didn't type out any of it so that there can be absolutely no errors in the information. That's my biggest concern. So then the neat little thing I did next, I've got this. Again, I did not type it. I used some ifs to work out how much is in each year group. So rather than seeing every single individual debt payment that needs to be made, debt individually, I've got the actual debt split into years. So 2023, 2024, 2025, and that means I can see the change much more clearly, and rather than just seeing every individual payment. So hopefully that makes sense to all of you. What I could tell, first of all, is the total amount of debt used to be 4.7561 billion. Basically 48 billion. And now in Q3 2023, it's actually a bit higher, just above 48 billion. And so there could be a couple reasons for this. I haven't done a test for it because personally I don't care. But the exchange rate, some of these are in euros, some of the debt payments are in euros, some are in pounds. This column converts it, and that's done by 𝗏𝗏𝗏𝗏 Discovery. It's their conversion rate. So some of it might have gone up because of the conversion rate, but it's funny because they say they paid off 2.4 billion in debt, and yet their debt has gone up. So that's the reason that we need modeling. And I think ultimately all we care about is, can they pay the short-term debt? And the answer is that's gotten a hell of a lot easier after this quarter. So 2024 has gotten much easier, and 2025 is still the big threat that we need to worry about. Particularly Q1 of 2024 is 2.5 billion. And so, yeah, I'm nervous about that. So basically that's what I'm going to be looking out for each quarter, is basically how much easier that gets. I'm not worried about them going bankrupt in the near future because I know their cash and cash equivalents are 2.3 billion. I know that this is more or less, oh my goodness, where we were a year ago. And where we were a year ago was we were at this point, and then in Q4, we just made a ton over Christmas. So that's what I expect to happen this year. And so I don't really think there's anything, like, I'm going to stay on the stream for a bit and just give my general thoughts, but there isn't a lot else to say. For anyone confused as to why the share price went down 20%, there's no logic to it. Don't try and extrapolate too much meaning from it. One of the reasons that I think it's done it, that I personally think, is the human obsession with decimals and tens and stuff like that. And basically, I think a lot of people might have set stop losses at $10. Not a hell of a lot of logic more than that. I can just see so many people setting stop losses at $10. And what happens is they're buying their stocks on Robinhood, eToro, all these zero commission. I'm personally on eToro, and I never use a stop loss because the way that these companies make money is not through commission. It's not through the spread. The spread is set by the market. They don't make a commission off their trades. They may make a tiny one, but that's not how they make their money. What they make money from is selling your data. And so if it ever feels like, oh, how do they just know exactly where your stop loss is? It's because they don't know where yours is, but they know where generally everyone's stop losses are on the platform. And so they have a good idea, if the price goes to a certain level, how many people on each individual platform will be forced to sell at that price because they themselves set a stop loss there. And so, yeah, if you're a billionaire institutional investor, you buy the data from the brokerage app, which is legal, fully legal to do. You buy the data from the brokerage app and you just push the share price down a bit. You sell a little bit of the shares, and like at every level, when people's stop losses get hit, you then buy them up, you gather them up, and you can buy way more shares than you need. You don't need to generate very much volume to get the share price to hit those levels. And then you just sweep them up. Once you've bought them, it becomes even easier to then lower the price even more. So I think what is happening is I think institutional investors have purchased a lot of stocks off retail investors, a lot of shares off retail investors, by forcing them to hit their stop losses. I have no way to back that up. I have no evidence. That's just my speculation. I'm so sorry about my coughing. I had a fresh chili in my lunch. So I think that's what it's doing it to me. Have I increased my investment for Warner Brothers Discovery? So I haven't increased my investment today. I have increased it slightly recently. I think what I want to see, I've got quite a substantial investment. So you can go to my eToro portfolio and you can see that I'm around 10% invested. Obviously that changes a lot. If the other positions in my portfolio grow, then Warner Brothers Discovery shrinks by comparison. La-di-da-di-da, all a bit boring, but it's a substantial position in my portfolio. It's around 10%. So I have to think a lot before adding to it. Obviously, I'm still holding it. So at this price, I deem it to be better value, and there is now less risk involved in the price. I think if I was to buy more, the next stage, I've evaluated the debt and considered and recognized that we actually have less debt going forward into the next quarters. The next phase will be earnings, and I'd need to evaluate the cash supply and free cash flow, and I'm going to do those things. So actually, I can show you the next phase of this. This is my confirmation bias preventer risk sheet, and I need to add in more of my investments here. Let me just see if it shows up. Got to give myself access. So give me 1 second. And anyone with the link. Cool. So this is how I prepare for confirmation bias. I always put in an expectation as to what I want when the earnings were released. And actually, I said that if free cash flow was above 1.5 billion, then I would buy more. And so I think I will. I think I am going to buy more because the free cash flow was at 2 billion. But I want to just do a little bit more due diligence on the change in working capital. Had revenues have gone up also, then it would have been like a double win. I'm a little bit concerned with the strike from the Screen Actors Guild and stuff like that and how that's going to affect future releases. But I most likely will buy more. I also wanted to wait until the markets are open. Markets are now open because I don't like having my orders there in case institutional investors see that and somehow I get screwed over. So yeah, I'm very interested in buying more and bringing my average down. I just happen to be substantially invested already. So yeah, my sell price was 500 million. Specifically, it was 792, and I just lowered it to 500 million. I raised it to sorry, these are all average free cash flows as well. So I need to actually work out what the average free cash flow is from the last 12 months. But the risk would have been negative 792 million. I remember that, but I didn't seem to write it here. I must have written it in my Google Calendar. So yeah, and that's where our cash supply is at. So you can see in Q4 last year, we went from 2.4 billion to 3.7 billion, and that was after paying off 1.3 billion in debt. We only have 1.8 billion in debt until the end of 2024. So if we ended up paying off 1.3 billion in debt, we'd have almost in Q4, we'd have almost in all of our debt paid off. And then on top of that, we'd have potentially 3.7 million in cash. So what I'm hoping for in the next quarter is that we're well above 3 billion in cash. That's my expectation in Q4. And I will adjust my expectations if substantial amounts of debt are paid off. So I would even be happy to be down to 2 billion if it meant that there's no debt payments in 2025 and stuff like that. So basically, I need to go through this all again. I need to update my expectations for the next 12 months, what I want at the end of Q4. I think what I'm going to be wanting for the end of Q4 is so I'm going to hold if we have 3 billion in cash. I'm going to buy more if we have over 4 billion in cash and we pay off more than 1.8 billion in debt. If we do all of those things, then we've had a phenomenal quarter. We're going to have an incredible year. And I think one of the things that people miss, is this stock will not appear on most people's screeners. I'm not sure what everyone screens for, but I think a lot of people are concerned about debt and they filter out for things with leverage. And, I do that on a lot of my screeners, filter out leveraged companies. And, this is kind of the issue with screeners, that companies like Warner Brothers Discovery would be left off when I can take you to their PowerPoint. And the most important slide is coming up. God, there's so many slides. There it is. So, and then so that was the first one after they became a new company. So this was Q2 2022, and they had 13% variable debt. Now they have 3% variable debt. The remaining of the debt, this makes sense. The average cost of the debt has gone up, and that makes sense because what they've done is they moved from having variable debt to fixed debt. Fixed debt is more expensive, but at the same time, the fixed debt is less than 5% annually, and they've got 3% variable debt. So we know exactly what's coming in terms of debt. We don't have to worry about that. The average maturity is 15 years, and some of it is far back as 50 years. So we really don't have to worry about any of this green stuff. We do not need to worry about. We need to worry about the 14% of the debt. And that's why I created these charts that are linked to in the comment section. They might be linked already, but I don't think they are linked in this video. So let me just go back and see if there's any questions. Yeah, the Cineworld burn still hits hard, so I'm cautious with high debt companies as well, and that's one of the reasons. And also, it's changed how I invest in general. So basically, I need to look for. This is why I've got more of a structure of. I've got to write down my thesis every time I buy more, which is something I recommend. It feels obvious saying it out loud. I feel like an idiot for not doing it before. But yeah, have a thesis and then before going into every earnings. There's not a lot else to say about this stock. It's all earning. Yes, it is. Right. So yeah, I took this sheet, I copied the information, I pasted it into here, and then I used some fancy substitutes, and then I used a split formula, and that's how I got all this data. And what I might do, although I don't think there's a lot of value in it, put some of the old data in to give us an idea of how much debt we've already paid off and how comfortable Warner Brothers Discovery is at paying off their debt. But let's just go back to their earnings, their general overview of earnings. I don't know which sheet will be better. I've got both of them up. So I've got this one, which is their latest, sort of more financials. And so what you got here, 3 months ended September 30th, 2023, 2022. And actually total revenues are up. So I'm lying there. Actually, total revenues are somehow up. Cost of revenues are up also. And so 2023 highlights. Studios revenues were 3.226 million. Revenues increased 3%, excluding FX. Context revenue increase. Let's just understand this a little bit more. This is the next phase of it. So I understood the debt, and that was the bit that was confused me the most going in, was that they said they paid off 2.4 billion. I ran the numbers. Their debt's gone up since the last quarter, but that's because they stretched it so much into the future. Network revenues were 4.868 billion. Revenues decreased 7%. We expected, I don't know if you guys remembered, but there was some sort of kerfuffle with Disney pulling out of sort of advertising revenue and stuff like that. Disney felt like they were getting shafted. They pulled out, and that led to people dropping their cable subscriptions, which led to Warner Brothers Discovery having less viewers on cable. And it's all part of this shift away from cable networks. People in the UK, like me, really have to do a lot of research to understand this, because we haven't had cable for a long time. The closest thing that we have is Sky News, and I think that's largely online already. Most people I know do not have Sky News. It's kind of a niche thing. It's a big niche. People have it for sports, but yeah, there's a lot of people that don't have Sky anymore. There was a thing when I was growing up, and I think it is naturally dying. I think Warner Brothers Discovery is going to have one of the best streaming platforms in the world, if they can make sure that they don't mess it up. They have one of the best financial structures for it. They've got all the intellectual property, and they have an extremely high free cash flow. And I think it's great when they have something like network TV advertising revenue supporting the business, so they don't have to entirely rely on the revenue generated by streaming platforms. The reason for that is it's a bit like when Apple release a new product like Apple Pay, and the margins on Apple Pay, for example, aren't as good as on an iPhone or on other aspects of their business because there's more competition. But the benefit is they've got revenue being generated from other places, so they can be more competitive. I think Netflix is already beginning to lose a bit of competitivity, but don't get me wrong, Netflix could be a big player for decades to come. Probably will be the biggest streaming platform for years and years to come. But the fact is, HBO and stuff like that, HBO Max, they're going to become these massive contenders in the space. I think in the future it will be that network TV doesn't exist and everyone owns 1, 2, or 3 streaming platforms. Anyway, that's just how I feel. Networks revenues were also, Netflix is going to be a very empty place when these companies pull 80% of Netflix's stuff at the minute is licensed, and a lot of that is Warner Brothers Discovery, and I did a video on it. Warner Brothers Discovery have like 200,000 hours of TV, and compared to Netflix, like 4,000. It's something ridiculous. Now, a lot of that is shit, but at the same time, like, it's still an incredible amount of content. And a lot of people forget that Warner Brothers Discovery have things like Harry Potter and now a credible new video game. They have a lot of gaming intellectual property. So there's a hell of a lot of stuff that isn't just film and TV. Anyway, this is why the top line numbers are so important. So total revenues, direct consumer segment. So I don't really care about, so that was network segment. That's down a little bit. I only care, and that was studio segment there. So studio segment was up a bit. And then actuals total revenues were up. Yeah, total revenues up. And then net loss available to Warner Brothers Discovery. It's always funny, it's not available. So in 2022, that was 2.3 billion. Now that's 400 million. So that, you can see that's an incredible improvement. Cash provided by operating activities was 2.5 billion compared to 124 million. So we are in an unbelievably better place. However, a lot of this is due to the strike. So that's another thing I didn't know if I was going to have time for to talk about in this video. But I think the strike seems way too intentional for Warner Brothers Discovery. It was way too beneficial. Obviously, the actors going on strike froze production of all the films, and all the cameramen, all the equipment providers, and all it costs. Honestly, it's billions, and a lot of that 2.5 billion will be the strike, the money saved from not producing films. Obviously, that's going to come back to bite them in the arse, obviously, and that's probably biting them in the arse right this quarter. And so that is probably why the strike action has ended at quite an interesting time. The fact that it ended just after they released earnings, I just find too suspicious. It was so convenient for paying off debt. It gave them so much cash in order to pay off debt. It just all feels a bit too convenient for me. Anyway, expect the cash provided by operating activities to go down in the next quarter. Expect revenues and earnings to go up and stuff like that. So reported free cash flow 2 billion, which is just so much higher than I anticipated it being. And let's just see if we can see distribution, advertising content. This is a segment, so I don't want segmented stuff. Inter-segment earnings, leverage, reported free cash flow, cash provided by operating activity purposes. So you got this 2 billion there again. 2023 outlook. Let's just read that. Warner Brothers Discovery may provide forward-looking commentary. Q3 2023 earnings conference call information. Oh, okay. So we could listen to the conference call. I'm probably going to do that another day when I'm going out for a walk. I'm just going to listen to the whole conference call just to get an idea of any other bits of missed information. But I don't generally like to listen to them because I find that they're a bit what do you expect them to say? They're just going to give you the company's answer as to... They do sometimes say interesting things, but you're going to get the washed answer. I think it's a good way to get an overload of confirmation bias is by listening to the company calls. Maybe you disagree with me on that. Let me know what you think. Any news when doing... so I'm going to do a portfolio roast. I think I'll probably do it either this Friday or next Friday just to give people some warning. But yes, looking forward to doing a portfolio roast video. So someone sent me their portfolio. If you want to send me your portfolio, you can send it to me on Discord. You can DM it to me, or you can put it straight into the group chat. Link to the Discord is in the description. And yeah, look forward to doing that. And so I'm just trying to work out how to do the format for it and stuff like that, and give myself a bit of time so that I don't totally embarrass myself. But yeah, so that will be happening. Let's commit to a time right now. When will the portfolio roast be? So Adam, since you're here and you're live, what time would work for you? You let me know. If you tell me what days you like, does Friday this week work for you? And if so, I'll do it then. And so I will... Friday this week at what time would it be? 3 p.m. potentially would be, again, a good time for me, probably. I think that's everything that I wanted to say about Warner Brothers Discovery. Stay 4 to 5. Okay, all right. Friday, 4 p.m. That's when it will be. And so, yeah, this Friday, 4 p.m. I'll put a message in the Discord if I have to change that time for whatever reason. Sometimes I forget to put things in my calendar. But yeah, look forward to that. And yeah, new video, by the way, going live on Monday. And I probably will try and do a video on a shorter, more concise video on Warner Brothers Discovery, potentially after I've listened to the earnings call. So yeah, let me know if you've got any questions in the comment section, and have a good week. Goodbye. So what? 4 to 5. Okay, all right.